Welcome to Show Me the Money with Michael.derk. Show Me the Money is a podcast that is bringing in industry leaders in the commercial real estate sector that are either on the financing side, the development side, the acquisition side, disposition, brokers, investors, bankers, management companies, everyone that's in and out of the business in all facets of the trade, so that hopefully you can benefit if you're looking to grow your business, start your business, or maybe transition into something else. Hello, everyone. I am Michael.derk, and welcome to another episode of Show Me the Money. We have a guest on today from our Seattle office. We have a gentleman named Clayton Brown who specializes in retail. Clayton Brown is the founder of the Brown Retail Group, Marcus and Millichap's premier retail investment sales team in the Pacific Northwest. In 2020, 22, 23, Clayton was the number one overall top producing agent in Marcus and Millichap's Seattle office and has made the number one producing retail agent in the Pacific Northwest in the firm for the past 6 years. In 21 and 22, Clayton received Marcus and Millichap's Chairman's Circle Club of Excellence Award, only awarded to the firm's top producing agents nationwide. Brown's retail group specializes in investment sales and financing of single-tenant net lease properties, shopping centers, and higher and better use sites in the Pacific Northwest, as well as nationally. Along with real estate, Clayton is also passionate about private aviation. He holds a private pilot license and an instrument rating and flies a G6 Cirrus SR-22T, which allows Clayton and the Brown Retail Group to effectively visit clients and see retail across the Northwest United States. Clayton attended Campbell University on a baseball scholarship where he posted a Division I second best batting average of .427 in his junior year. Wow. In his personal time, Clayton is an avid reader and enjoys traveling, skiing, fishing, being outdoors, and spending time with his friends and family. Clayton, welcome to the show. We're really honored to have you on. You are the first guest not to have a plane and be in aviation, but you are the first guest up in the Pacific Northwest that we have on the show. So again, we're trying to keep this national across the whole country and all different product types and all different individuals in commercial real estate so people can learn and grow their business. So maybe if you can touch a little bit on the retail market now, Clayton, of what you are seeing, if you could please do so, we'd appreciate it.
Sure. Well, thanks for having me on, Michael. And you made the comment about my batting average in baseball in college. And now, unfortunately, I don't play baseball anymore, and I'm trying to work my slice out of my golf swing. So it's actually not a benefit to me anymore having that average. So, let's talk retail overall. As Michael mentioned, I am a retail specific agent, and really for retail as a product type, I mean, outside of the capital markets conversation, retail remains strong. And, we did see the first decline in overall retail sales in the May numbers that just came out. It was a, 0.9% decline since the April numbers. But overall, I mean, we're up 3.3% year over year. And I think that decline was largely due to that pull forward spending that we saw due to tariffs and, people looking to get ahead of potential price increases due to those tariffs, which obviously makes a lot of sense. But, for retail, I love the saying, don't get in the way of the U.S. consumer in a cash register, because the U.S. consumer just keeps spending. And so retail overall is strong because of that. But, that said, it's not that retail doesn't have its challenges right now also. I mean, if you look in 2024, we saw over 45 retailers file for bankruptcy, which was nearly double the amount that we saw in 2023. And so, candidly, all the headlines that we saw regarding bankruptcies over the last several months has certainly kind of permeated the market and has certainly influenced buyers of net lease and shopping centers and has delayed a lot of transactions and has unfortunately, kind of led to some transactions being terminated, which our team has been a part of. But on the flip side of that, there is a silver lining with bankruptcies, and it can actually be a good thing for a landlord if your bankrupt tenant is paying well below market rent, or obviously if a tenant's going bankrupt, they don't have a good credit signature, and so a lot of those leases are put up for sale. A lot of them are being bought by credit tenants. A perfect example for this in the Pacific Northwest is with the recent Rite Aid bankruptcy. And with Rite Aid, CVS ended up coming in and buying 64 Rite Aid locations in the Pacific Northwest. And the drugstore space is challenging right now, as everyone knows, but CVS is the clear winner right now. And their stock price is up nearly 50% year to date. And so, as a landlord, if you have Rite Aid replaced with a credit tenant like CVS, obviously that'll boost the credit profile of your property, significantly. So, I'd say overall with retail on a national level, there's certainly winners and losers, kind of in the retail space right now. But overall, it remains a very accretive asset type. You just need to understand the market and really find the right deal.
Right. Absolutely. And the one thing that we've seen, obviously, cap rates have gone up significantly over the last couple of years with the cost of capital. Whether sellers want to realize it or not is a different story. So if you don't sell your real estate, buy real estate, or finance real estate, guess what? Real estate's worth whatever you want to call it to be on your piece of paper. So that's where we have a lot of clients that feel that real estate is worth a certain value, but in reality, the value of anything is what someone's willing to pay for it. And so that's where the rubber hits the road. In the financial markets right now, just to comment on what you're saying, we have seen more activity over the last few weeks here, this summer of 2025 than we've seen in the last couple of years. We've actively been closing deals all over the country, especially on the retail oriented side of everything, where deals that we're starting to see sellers start to move into the market and starting to see them, be a little bit more realistic. And with the amount of capital offering interest only and non-recourse and being able to potentially break some debt coverage ratios, we are not seeing, I don't want to go out on a limb and say positive leverage because the cap rates are still south of the interest rates of what we're seeing right now, unless there is a shorter term lease or the credit's not there with the tenant. But there is a lot of capital. And if interest rates do fall, which everyone is anticipating, it's been 2.5 years that they eventually will fall. Maybe they will, maybe they won't. It's above my pay grade. And I think it's above Powell's pay grade, who actually sets these rates, because I'm not sure if he even knows. But in the big picture, when rates do fall, the clients who have taken advantage of deals in this market will obviously come out looking very, very strong, because my best clients that I've worked with over the last, 23 years of being in the firm and 26 years of being in commercial real estate have often bought in times of very dark, in darkness and an uncertainty, I would say. And so in that time, you can create opportunities, just like you're saying, with Rite Aid going out of business is a perfect example. CVS obviously is coming in and capitalizing on their well-located sites and taking market share from a company that has struggled, and in turn, obviously growing their share price at 50%, where other retailers, and especially drugstores, are really struggling. And from the financing aspect, we just got some strong terms on some Walgreens and working on some CVSs right now. And the Walgreens are tough, but we still get terms on those. And then on the CVS, obviously, that is the darling right now that we can get very, very positive financing for. So overall, we're starting to feel some momentum in the market, and we feel very good about finishing up this year of 2025 and going into 26. There's approximately like $1.4 trillion of debt that needs to roll here in the next 12 to 18 months. And so that's going to create so much opportunity for everyone who's in the commercial real estate arena. There's been so much pent up demand. There's so much cap on the sidelines, and there's so much financing available for these deals. So with a willing seller that's willing to meet the market, the buyers are there ready to capitalize again on these opportunities to grow their portfolios and to make sure that we're working with, today, real operators versus an equity trade, instead of, just moving, trading, like hotcakes. People are actually have to operate their businesses today to create value. That's the biggest difference I've seen over the last couple of years. Moving on, Clayton, given your experience with single tenant net lease and shopping center sales, what trends are you seeing in tenant demand or cap rates across the Pacific Northwest right now?
Sure. So, yeah, I mean, just to start with the Pacific Northwest overall, I mean, we have arguably the tightest retail market in the country. And CoStar wrote an article about this earlier in the year. I think it was back in March, which compared Boston to Seattle, and they deem Boston and Seattle as the two tightest based on all these metrics. But overall, the Seattle MSA has the lowest amount of retail per capita of any major metro in the country. So, I mean, that bodes really well for, strong rent growth, right? Low vacancy. Really across the Seattle MSA, we have a sub 3% vacancy, and obviously strong tenant demand. And we have affluent demographics as well with all of our, tech jobs and tech growth that are here in Seattle. So when looking at retail overall, our team is really kind of balanced between selling net lease and then shopping centers. We really divide those two product types kind of into two, between net lease and then centers. And the three main food groups of shopping centers are going to be, your strip retail, your anchored centers, which includes power deals, and then your grocery anchored retail, which is, obviously primo for a lot of investors that want centers. So with net lease, Pacific Northwest cap rates command usually between a 35 to 50 basis point premium over other states. And I'll just have a caveat there, and I'll exclude California and Florida because obviously those states are a little bit different. Florida, especially so, with all the growth that's happened there. Really, for pricing, the break point that we see is right around a 6% cap rate for net lease, where if the tenant doesn't have a strong credit story, if you will, it's very challenging for us to sell that property for a sub 6% cap rate. We can still get even sub, 5% into the fours, but those are reserved for your, McDonald's, Chick-fil-A's, Raising Cane's, some ground lease tenants like Taco Bell, Wendy's in some circumstances, et cetera. But if it's not a credit tenant, we'll easily be north of the 6% range, potentially in the 7 to even 8% range if the tenant is not doing well and there's a bunch of headlines that are kind of against them, talking about how they might be filing soon, et cetera. I'll switch gears and talk about new development. The main tenants that are doing, new development and not really build-to-suits, they're doing a lot more ground leases just because developers aren't really interested in taking the risk of doing a build-to-suit right now, just given how high construction costs are. I mean, really, for a build-to-suit to work in the Pacific Northwest, given our land basis, is usually a lot higher. We've got to be north of like a $60 per square foot rent, which not a lot of tenants can pay the freight on that. So a lot of our developer clients are doing ground leases with a select number of tenants. Those tenants are, Chick-fil-A, Raising Cane's, Wendy's, Quick Quack Car Wash is a big new one in the Pacific Northwest. Valvoline is still active with their corporate signature and just a kind of a less expensive building to build, right? A Valvoline. And then the newest tenant that's entering the Pacific Northwest is Seven Brew Coffee, which we're very excited about. And we're actually working with their developer and tenant who's going to be, kind of rolling out 25 locations. So that's kind of the development, outlook. And then switching gear to strip centers. Strip retail is still the darling of the retail space right now, and that's been true for several months. They've held their value with interest rates coming up better than almost all net lease tenants, which I personally did not see, 3 or 4 years ago. And I think the reason for that is strip retail is a lot of service-based tenants that Amazon, hasn't wiped out, and they've adapted. As your dentists, your hairstylists, your salons, et cetera, people that actually need to be going to these physical locations. And then usually strip centers, especially if they're built like in the previously then from 2010, have below market rents, and so there's some pop there over term. As you get to options, we can work out a fair market value renewal, or maybe there's no options and you can reset that rent to market. So for cap rates for strip, we're really seeing, high 5% cap rate range to the high 6% cap rate range in general, depending on the credit of the rent roll. And then with less credit retail strips and less desirable locations being in the, 7 to 8% range. And obviously there's outliers across the board with that, but that's kind of in general. And then for anchored and power deals, those are largely being priced on spread right now, as they almost always have been. And really our feedback from buyers is they need, really at least 150 basis points between available interest rates and where we're landing on cap rate, with some upside above that. And if we don't really meet that criteria, it's just a challenging deal. And so we're really pricing those on spread. And then for grocery anchor deals, we've seen core centers trade in the Seattle MSA in the high 5% cap rate range still for an institutional deal above 20 million, which is outrageous. I mean, Michael, you made a comment about how we're in a negative leverage environment. I mean, that's, a lot of these grocery anchor deals, there's not a whole lot of upside. It's just buyers are buying for stability.
Right.
And then for
land banking.
basically land banking. And then for less credit grocers, you're 6 to 7%, range. But, to your point, Michael, there's lots of buyers out there right now. It's certainly a buyer's market. And just a quick stat to throw out there, overall in the second quarter of this year, we saw a 19% increase in the amount of LOIs that we received on our listed inventory versus the first quarter of this year. And that's just, you can feel that we're getting more phone calls, we're getting more inquiries on our deals, more offers. So I do think that the market is starting to trend in the right direction, especially with, bonus depreciation was just passed in Trump's big, beautiful bill. That will
Yes.
help significantly for people just to buy for tax advantages.
Right.
And,
That's going to
I think the
probably,
reason,
yeah,
yeah,
that's probably going to push cap rates down, I would think, on the C stores and the car washes and those types of properties that are going to benefit from that bonus depreciation. That's a huge tax play for clients. And I think the clients who are focused on those properties, I think, are going to see price appreciation.
yeah, yeah, price appreciation, or it'll just close the gap between buyer and seller on deals that are
Yes.
sitting on the market, which I think is maybe more likely. But if we can get a couple, reductions from the Fed coming up here, I think to your point, pricing could actually be going up again. But yeah, I mean,
Right.
the 10-year Treasury has really been range bound between that 4 and 4.5% for several months now, and I
Right.
think we've got a lot of comps too to show because if when we were in 2023 and 2024, it was like who knows, right? We're pricing basically on market comps. Now
Right.
we've got several comps to point at, and so I just think buyers have some consistency with their debt and
Yes.
consistency with comps, and so they feel good about writing offers, or they feel better about writing offers right now.
Yeah, absolutely. I mean, there should be no excuse where a person can't get debt for a deal today. There is a plethora of lenders out there for every deal. It's just a matter of if those terms work for that buyer. And I just can't. It's so funny on how many sellers we work with on different deals, and we ask the seller if they would buy their deal at the terms that they're looking for, and I would say 99% of the sellers say no, they wouldn't. And so again, we ask the question, well, why should the buyers be willing to pay the price that you won't buy it for? And so obviously everyone has different motivations.
Yeah,
When you're a 1031, you're obviously much more motivated to mitigate the tax consequences. But I think that bonus depreciation that you just that hit on, that's a great point with Trump's big, beautiful bill that he just passed. That's going to have a huge, huge onslaught of activity for a tax benefit that a lot of investors look for. Because, I mean, let's face it, at the end of the day, when interest rates are going down, everyone's playing and having fun with the equity appreciation. But when the market is stagnant, has gone down like it has over the last couple of years, people look for tax breaks. I mean, as far as real estate goes, that's why, stocks and bonds and other types of investment vehicles like Bitcoin, you don't have that tax shelter. Whereas real estate is
right.
still really the safe haven for that depreciation. In this case, the bonus depreciation of those types of assets will really help sustain the market and probably move it up in that sector, in my opinion.
Yeah. Well, and you can exchange it. You have a stepped up basis. You have a rent increases.
Right.
Absolutely. I mean, when people say that objection to me, like, oh, the 10-year Treasury is 4.5%. Why would I buy a 5% cap rate deal? It's like, has anyone gotten rich off buying Treasuries? Right.
Right.
That's exactly what I say to them. It's like, no, of course not. People build wealth by owning assets long term.
It's all about the long game. And they can say what they want with inflation being in check. I don't know about you, but the last time I've gone to the grocery store and a bag of groceries is less than 70 or 80 bucks, the price of goods are not coming down, and I don't see wages going up exponentially to offset these. So inflation is here to stay, and I'm happy to challenge anyone on that. And the wages, I mean, hopefully they increase, but it's just not going to be at that rate. So hard assets like real estate are really going to be a key factor to hold in everyone's portfolio to create wealth over the long run, because otherwise you're just going to sit on a treadmill and not get ahead. And the taxes that will increase and all the other factors of life will unfortunately take hold. So hard assets are going to be critical. Moving on to the next point here, Clayton. When representing sellers, how do you position property to attract the most competitive buyer pool, especially if the asset has gone through some challenges or maybe is in a secondary or tertiary market, or maybe have had a blighted, kind of a blight on the deal as far as maybe if it transitioned or had a Rite Aid in there. What are you doing for clients today that's different maybe from other investment brokers?
Right. Well, I think every deal and every seller stands alone. And so I think it all starts with really managing a seller's expectations about the realities and challenges in today's market. Because candidly, there still are, a lot of challenges that we've been talking about. So, I really want a seller to know everything that our team is seeing and hearing from buyers when transacting. I mean, we are in the trenches. I mean, we talk to several buyers every single day. Buyers are the professor in the market, right? They'll tell you what value is. They'll tell you what their perception of all of the noise and headlines are, and rates and tenants and everything else. And so we really take a true partnership approach where, we make recommendations to sellers like we have 50-50 equity with them in the deal. That's what I teach my agents. That's what I'm always communicating is, hey, this is what I would do if we had 50-50 equity in the deal. And so if we look asset specific on, how to best, position properties, obviously the first thing is we need to price the property correctly. That's the most important thing. And really a common theme with buyers that we're seeing is, if a deal's not priced correctly, and really it's pretty tight, it's preferably within 25 basis points on where that deal will trade on cap rate of the market value. If it's not within that range, we will really struggle to get buyers to put pen to paper. I mean, we encourage buyers, hey, submit an offer, even if it's 10, 15, 20% off of the asking price. Submit an offer. I mean, there's so many opportunities out there. Again, this is a buyer's market,
Right.
but so many people are just hesitant to submit offers when, candidly, I mean, you mentioned if rates come down, buyers that buy today will be looking very smart. It is a
Right.
great buying opportunity right now. You want to buy in a buyer's market and sell in a seller's market. Right now, we're in a buyer's market. So I
Right.
just think there's a little bit of a complacency that's in the market. But candidly, the second quarter, we did see, more buyers kind of coming off the sidelines. And I really do think that that's going to continue throughout the balance of this year. And then obviously for positioning, just lease term length for retail is very important in today's market. Mike, we can talk about the financeability of a short term lease and the challenges that that brings. So if we're getting ready to bring a net lease property to market, it's got less than 5 years of term. Our immediate recommendation to the seller is, hey, let's get the tenant on the line. Let's see if they'll do an early blend and extend, or exercise an option, something to get that lease extended. And it's the same thing with an anchor deal or with a strip center, a big tenant that's paying the majority of the income. We want to make sure that they've got term. For the financeability, we want to make sure we have staggered lease expirations. And so that's all part of our BOV and positioning process. And we've got so many strip centers, anchored centers that we're positioning right now that we've been positioning some for a couple of years, preparing for the right time to go. And
Right.
again, I mean, if we're taking the partnership approach with a seller, I'm not going to make a recommendation to a seller to go if it's not the right time to go. But if it is the right time to go, I'm going to be the first guy to call you up and say, hey, this is time, and I'll say it with certainty because of that.
Right. It always amazes me how buyers, if they're in the market with capital to buy a property and they like the property, I just I don't understand why they don't make an offer. It really surprises me how, that's like the property's listed at a 5.5 cap, but they wouldn't pay a penny less than a 6 cap. Why don't you just write the offer at a 6 cap? I mean, you can maybe start to get it close to that number. And if something shifts in the market, good, bad, whatever it is, it could hit your number, or you never know if that seller is really motivated to take that deal. If it's strong terms and you believe in the deal, you've done your due diligence, you go in with relatively low contingencies, you put up a nice deposit, maybe even do a pass through day one. It just amazes me how I don't see that. And I'm amazed how many agents don't encourage the buyers to write as well. Like, oh, it's a 0.5% cap rate off. That seller will never even look at the deal. I'm like, the market is the value of real estate, and the market is what someone's willing to pay for your property. And if you're not a real seller and not really looking to meet the market, don't put the property on the market,
Right.
right? Go get an
Totally.
appraisal, hire an appraiser, and go have them do the appraisal and send them a report. Why do you waste everyone's time? I mean, that's what I say. But it's shocking how the buyer is just like, oh, it's too expensive. I'm not. Well, what would you pay? I'll pay that. Oh, we'll write it. No, we're not going to write it up. It's very
Exactly.
strange to me how that mentality is in the market. I don't get it. I personally, when I'm looking to buy real estate, and I look at a price, I write at that price. And sometimes the sellers are like, no way. Sometimes the sellers are like, no, but I will take this. And I'm
Right.
like, whoa, that's a lot closer to mine than actually what he was looking for, or she. And and all of a sudden you might make a deal, right? And it shows the seller too, in reality, what the value of his or her real estate is worth.
Yeah.
I mean, everybody can list anything they want for any price they want, but in reality, again, it's just what someone's willing to pay. Clayton, walk us through a recent deal you've done that best reflects the strengths of your team, and why was it so successful?
Okay. Yeah, so I'll walk you through a deal that we closed just a couple weeks ago. Actually, it was a roughly 180,000 square foot anchored deal in Washington State. Had Burlington and Dollar Tree were the two main tenants. Included 5 pad buildings as well. It was a good deal, but had a lot of value add and just a lot of decisions and a lot of time that would go into the project. Overall, kind of a sad story. It was an off-market deal where the seller didn't want to list it, but was open to receiving an offer on it for whatever reason. So we said, okay, we absolutely can do that. I made a call to a good client of mine who I met actually through private aviation. He also is involved with Cirrus, and he flies. He has the same plane as me, basically. So, anyways, negotiated the deal. We went under contract, and within the first month, I'll never forget getting this call, but my client calls me and says, hey, I was just diagnosed yesterday with colon cancer.
Oh, I'm sorry to hear that.
So, I mean, obviously, when that's never happened to me, and God willing, it never does. But obviously, when your health is impacted, all of these things that we talk about, real estate, what debt is, I mean, all that takes a backseat. And so he was like, hey, I gotta work on my health. I'm not going to be able to move forward with this deal. But he said, however, instead of terminating the contract, he said, I would be willing to assign the PSA to you. And he said to me, and I was like, whoa. I was like, okay, I've never even thought about that. But I was like, at first, there's no way, right? It's a 180,000 square foot center. I mean, I own a few different deals myself, but nothing that big. And so I was like, okay, I mean, I've never raised the money. I don't have the money myself to buy a deal like that. So I was like, okay, well, let me sleep on it. I told him I'll get back to you in the morning. So basically, I called him up, and after I slept on it, I was just thinking, hey, I can figure this out. I can bring another developer client of mine in. We can get the money raised. It's a great deal. So why don't I just see if we can put it together? And so basically, I said, I'll take it. And so called the seller up, told him what we're gonna do, and the seller was open to assigning the contract to me and my team. So we're off to the races. I had to put the entire earnest money deposit in, which was a large chunk, and ended up bringing in another good developer client of mine as kind of a 50-50 GP on it. And we immediately got going pre-leasing the center. It was a year-long leasing effort. We actually have a leasing agent that Marcus and Millichap hired. We're growing our leasing division at Marcus and Millichap, which I think is great.
But it is good. A lot of people don't know that. That's great.
Yeah, a lot of people don't know that, but I'm glad we got a chance to touch on that. But yeah, I mean, it allows you to control more of the market and also just add more value to sellers, especially with retail.
Absolutely.
If you have a hole you need filled before selling it, I mean, that's huge value. Right. But anyways, we had several national tenants interested in the center prior to closing. We ended up raised the $5 million, and then get this is the curveball of the deal, and Mike, you'll appreciate this. The week of closing, we had loan approval. They were drafting loan docs, the lender, and an estoppel came in from one of the tenants. It was just a local tenant, had one location that we were planning on, kicking out to bring in a new national tenant. That's still our game plan. And we negotiated a 50% rent reduction with them, converted them to month, and the lender saw that on the estoppel, made a huge deal out of it, ended up pulling loan commitment.
Wow.
And we were forced to call the seller, negotiate a 30-day extension, had to put more non-refundable earnest money down. We pivoted to another lender who was able to get the deal done within 30 days with a new appraisal. And we ended up closing the deal 2 weeks ago. So full team effort from our leasing agent, our lender, our new lender, the old lender I'm never going to talk to again, right?
Right.
Marketing coordinator, escrow coordinator, our attorney, our investors that came in on the deal, and then, of course, the seller for his flexibility. But I think it was just a lesson in courage. And, one of my favorite sayings is, fortune favors the bold. And so I think for that, it was just a good deal to make happen. And we ended up closing it out, which was awesome.
That's great. That's an awesome story. And, that's one thing too, that brings into the point where when especially we're working with an intermediary in the market versus working with one direct lender. I mean, there's so many clients we've met over the years where that client has had that long-term relationship, right? And we value relationships more than anything. Obviously, you and I have known each other for a long time now, but in the same respect, when you have your eggs in the basket with one lender and you don't have an intermediary in the middle of a deal to be able to pivot quickly and move into another, another lender, right? And have that package ready to go, you're flat-footed, and
Yes.
it's not a good place to be. And we help so many clients like that over the years to constantly be successful and to make sure that they're going to execute their game plan. So I think it's very, very key, and that's great. And congratulations on getting that done. That
Yeah.
seems like
Thank
a
you.
great opportunity. And again, I'm sorry about your client and the issues they had, but that is a motivated individual. We always talk about, in real estate, what the motivating factors are is usually death or divorce or a partnership dispute or a major health issue. Those are usually mostly the four motivating factors that triggers when someone is actually going to move to the market to sell the asset. With your national reach and aviation success, how do you prioritize, maintain relationships across all the markets you're working in, and still deliver that level of service to each client? Like how many hours a day? I mean, just so people can understand what it takes to be successful, especially in this market. It's one thing if we're in like 20, 21, 22, it kind of call it the pizza boys and girls are in the market, making quick bucks here and there because everything's just going up quickly and people are flipping deals. But today, it actually takes expertise. You actually have to read the documents. You actually have to understand everything and work with true operators who understand how to operate the cash flow, not just the top line, but the expenses as well, because that results in the bottom line. So if your bottom line is going down, the value of your property is going down in a very, very quick way because the cost of insurance and interest rates, labor costs, supplies, like you said, construction costs, these things will eat you alive very quickly. And if you don't have a solid business plan with the right acumen and the resume to be able to manage this, you'll have a very short business. So how are you doing it, Clayton?
Yeah, I mean the devil's in the details. To your point, I mean it's been true in the past. It's even more true in today's market when margins candidly are tighter, and if you're caught on the wrong side of that, that can be obviously not productive for your business plan if you're raising money. We've seen a lot of people on the GP side have to pivot and let go of all of their promote just to make their investors whole, which is the only decision you can do as a GP, right? I mean, a lot of our clients have had to do that, so
Right.
yeah, that's been tough. You talked about aviation and how I've kind of been linking that into the business as well. That's actually been highly productive for networking with clients because a lot of high net worth people do fly private, not all of them, but some. And it's a big thing that I've found is there's a lot of people that actually fly themselves that are high net worth that own real estate. And so I mean, not a lot of brokers, fly planes, right? So that
Right.
instantly has, a lot of rapport. And I've met several, big time clients through aviation that actually fly themselves or
Right.
just sit back seat, but maybe want to sit right seat just with the pilot and they're passionate about aviation, but maybe they don't want to be the only pilot. So
Right.
then of course, just convenience. I'll give you an example. Yesterday, for example, I had a couple meetings down in Portland. I live in Seattle. Usually, it's about a 7-hour drive to drive all the way down to Portland from Seattle, turn around, drive back. Usually, you get hit with traffic on the way back. It took me round trip an hour and a half yesterday to fly down and to fly back after my meetings.
Wow.
So I was back in the office by 3 p.m. Had several other meetings with my team, positioning BOVs that we're presenting this week, and so it really does save a lot of time.
That's great.
And then yeah, and then just talking about clients and I'm really at a point in my career where I'm really able to pick and choose who I work with and who I really prioritize. And it really just comes down to who I like working with and who treats our team with respect and just overall clients that are good people. And it always amazes me when people, don't really want to take a broker's call as well, who's active in the marketplace. Like I get if a broker's brand new, that can be a little bit different if he doesn't have a whole lot of, deal flow and whatnot. But if you're a client, you're not taking a broker's call. Do you really think he's going to call you with a good deal? Like you're going to miss out on a lot of business by not treating brokers with respect. And so, time's our most limited commodity, and I really just want to spend it working with people who I enjoy working with at the end of the day.
Right. No, that's terrific. That's great advice. And the hobby as far as a plane, that's obviously helping you in your business, but the people you meet when you're flying with or training with or whatnot. I mean, the clients, we just closed a deal down in Baton Rouge a couple weeks ago, and the client just mentioned in passing that he had a private plane, and I was like, wow, that's really impressive. And but the more the fact that just to have a hobby, right? Whatever hobby it is, maybe it's not jets, that's pretty expensive. Maybe it's boating, maybe it's
Right.
skiing, maybe it's running,
Golf,
maybe it's golf. Like
big one.
I'm a big golfer. I've golfed since I was 4 years old. And so I use golf, and the amount of people I've met in business, both on the financing side as well as on the principal side, and all facets of bringing in all these different people to golf for tournaments that I meet them in, or bringing them to courses where I play or belong. It's a really great way to network. And I really hope that the younger people who are starting in the business, again, you don't have to be some superstar in whatever it is. Just practice at it. It's a great outlet to the amount of pressure and stress that we have in this business, because if you're going to be successful in this business, I guarantee the amount of stress will be absolutely monumental. And if it isn't, you're probably a machine. I mean, that's great. I know that Clayton, you deal with it. I deal with it personally.
Yeah,
Every top producer in our firm deals with very high levels of stress, and that's usually if we're not talking about taxes or something else business wise, we talk about how to manage stress. And great way to do it is to create a great hobby, and to be able to meet clients with that hobby is a great way to transition that into potential relationships and business as well. So I think that's excellent. So thank you for touching on that. Um, Here's my best part of the show, as you know, Clayton. So everyone has their highs and lows in their career and in life. Can you share something in your business or life that is the low point, and then more importantly, how you came back to show the resilience of a very sound professional who's been so successful like yourself?
sure. Well, I'll start with a kind of a success story, and then I'll kind of end with that learning experience. So I think for people that are watching this that might be younger brokers or maybe newer investors, I'll tell you the story about how I bought my first investment property, which I'll tell you about, which was unique and not something that I've heard of anyone else kind of doing before. So, anyways, back in 2018, my goal was to buy a fourplex in Seattle and owner occupy it. So essentially what I did is obviously we cold call basically for a living. So that's, obviously my strategy was to call. So pulled a list of potential fourplexes to buy off market. And my criteria was very simple. I wanted to be within a 15-minute drive of the Millichap Seattle office. Didn't want to commute too far. I wanted 1970s construction or newer, just because I didn't want to deal with a very old property. There's a lot of old properties in Seattle. And then I wanted a neighborhood that I wanted to live in myself. I mean, that was pretty much it. So I boiled it down to a list of 20 properties that fit this criteria. And I picked up the phone on a Saturday and just started calling. After several people, told me, "Hey, Clay, I'm not selling. Don't call me anymore." Right, your typical, cold call. I got in touch with one landlord. His name was Dave, and at the time, he was selling some multifamily stuff, not the fourplex that I called him about. He said, "No, we're not selling that." So I said, "Okay." Met with him, kind of coached him up on net lease. He was in a trade at that time, so I started sending him inventory. Ended up putting him under contract on a Dollar General. We were working with a Dollar General at that time, or a Dollar General developer at that time that was building a ton of them in Washington State. So ended up closing on that. And then he had a couple other single family homes that he was selling. He was going to tie both up, sell it to one buyer, and then roll it into another Dollar General. So we put another one under contract. Literally 2 weeks after we sign a contract with my developer client for them to buy the second Dollar General, the buyer for their down leg falls out of contract. So we don't have the equity in the exchange anymore to buy the Dollar General. And right away, I'm like, "Dave, why don't you sell me the fourplex? You can exchange the funds that I give you into the Dollar General, and we can still do the deal." And he said, "Well, I need to talk to my wife," but he's like, "That potentially could work." And so, anyways, fast forward to the next day, I get a call from him. He says, "Okay, we'll sell you the fourplex, but we need to move on this right now." And so that was a great story because I ended up buying the fourplex, exchanging my proceeds into the Dollar General, and then I got paid a commission on the Dollar General. And that was the first deal that I ever bought. And I actually live in the property today. It's got an owner's
Wow.
unit that's a penthouse that I
Oh, I love that.
I fully renovated it, and it's doing great. And I've sold the same client, Dave, and his wife, Mel, 7 or 8 deals, and we just put another one under contract for them. It's a Denny's in Washington State
Oh,
two
good for
weeks
you.
ago. So that'll be the ninth deal. So
That's a great
yeah,
story.
just kind of a funny story, but I think that'll relate well to brokers trying to, get their first deal and just kind of how that went down.
Right. That's great.
And then I guess the kind of the challenging one. So this one I'll tell you about was earlier in the year. And, we had a client who we had sold a property to last year, actually, who unfortunately passed away.
Hmm.
And he was single at his time of passing. So the whole estate transferred to his heirs, and the heirs inherited the asset and decided to sell it. And it was a large single tenant property and then a large shopping center. There was another shopping center that I had worked with this client on over the last 7 or 8 years. Recommendations on who to lease property or lease, space to tenants just to increase the value of it, etc. And the heirs had a ton of paperwork from me, and we were the incumbent on the single tenant deal. We thought we had the deal in the bag, right? And so we did present a BOV, but we didn't go all out on our presentation. We thought that we were the incumbent, we were going to get the deal, and that there's no way that the seller would go around someone who had the actual relationship with the owner who had passed. But the heirs who inherited the property didn't know all the conversations that I had with the owner, right? And so to make a long story short, the heirs interviewed a few other brokerage firms who went above and beyond with their BOVs, ended up cutting fee and doing it for a lot less, and we ended up losing both assignments.
Wow.
And so that was a huge gut punch. Arguably, the biggest gut punch that our team has had this year. It was, close to 20 mil in volume between the two deals. And I think the lesson of the story there is, never take any assignment for granted, and you're only as good as your last deal in this business.
Absolutely.
You cannot rest on your laurels. You are only as good as your last deal. You have to stay sharp. You have to prepare like this is your last assignment and this is your first deal. And that. It was really good that happened to me, because that reset my expectations for our BOV process, which really improved it. So I do think that things happen for us, not to us. And that's one big improvement that we've made this year because of that.
Well, that's a great story. And I think a lot of people are going to learn from that. And some people, even the best of brokers who I've competed with over the years, I'm like, there's no way I can beat them, but I'm going to give it my all. And sometimes they don't give it their all in the presentation. I've been gaining some of my largest clients on these deals over the years. And I've also lost some where maybe I just wasn't as sharp that day, or just thought, again, as incumbent, some in a long-term relationship, and all of a sudden you get beat, and it's just like, whoa, what just happened, right? And it's a wake up, and you can't take anything for granted. I mean, that's the bottom line in this business. You are only as good as that last deal, and maybe not even as good as that last deal. You're good as that moment that you're presenting, and how you're going to execute, and why you're going to be different, and how you're going to add value. If you can't answer those questions specifically, succinctly, with a clear, concise business plan, and tell the client on how they're going to be exiting, what kind of return they're going to make, what the costs are, why they're going to do it, what the timeline is, go through the continuum of the process. If you can't articulate that, you're a dead man walking. So,
well said.
Yeah. So those are key factors. Thank you for sharing that story. Those are the deals that keep us humble, no matter how many deals we close, no matter how much money we make. That's what really, brings you down to a different level, and will continue to keep you hungry and continue to be successful in these times, especially as, the uncertainty and volatility remains in the market. So that's pretty much everything I have. I can't thank you enough Clayton for coming on the show. It was really an honor to have you on here. Thank you for the dialogue and talking about the national retail market, and specifically the Pacific Northwest. I wish you the most success. And again, I really just thank you for being here.
Yeah, absolutely. And speaking of golf, Michael, if you're going to SIA next week, we should get around in.
I will be there for sure. I won't miss it for the world. We'll be there in Colorado Springs. The firm does a great job to host us, so I will see you there for sure. Well, everyone, thank you, Clayton. Thank you, everyone. Have a great day. That's a wrap for another episode of Show Me the Money with Michael.derk.